As you saw in the unconditional analysis guide, you can set the amount invested in each stock in the Portfolio Holdings module. The portfolio is the aggregate of these holdings. This tutorial will show you how to analyze both historical and simulated portfolios and determine the optimal holdings for a given set of investment criteria. Click the Portfolio button on the ribbon. Note, the unconditional statistics and time series analyses are the same as those explained in the unconditional analysis guide, but applied to the portfolio instead of individual nodes. Therefore, this guide omits a discussion of these options. Click on Heat Maps. Select Explore as the solution type. The expected returns, correlations, and standard deviations appear. Expected returns measure the reward for each node. In this case, the Explore expected returns are simply the arithmetic average of the historical returns. These are approximately 0 for both Google and Exxon. Correlations indicate the similarity in performance between nodes. For example, nodes that advance and decline simultaneously have a correlation of 1. If one node declines when the other advances, they have a correlation of -1. If they are independent, the correlation is 0. Each node is perfectly correlated with itself, and consequently, the upper left to lower right diagonal shows all ones. The heat map shows a correlation of 1 as red, 0 as white, and -1 as green. The other colors are interpolated between these three. In this case, Exxon has a higher historical correlation with the US of 0.68 than with Google, 0.28. Google has a lower correlation with the US, 0.45, than Exxon does. The table at the right of the graphic shows the historical standard deviations of each node. Standard deviation is typically used as a measurement of risk. In this case, the US market has a lower risk than either Exxon or Google. Exxon and Google have very similar historical standard deviations. Set Validate as the solution type. This shows the expected returns, correlation matrix, and standard deviations for the simulated data. The simulated expected returns compare to the historical as follows. Exxon and Google are higher, and the US are lower. The simulated standard deviations and correlations are higher on average than the historical ones. In the next step, you will determine the optimal combination of Exxon and Google given these risk and reward values. The heat maps can help you determine what the optimal solution will be. If the risk of one holding is larger than the other, then the optimizer will tend to choose the less risky holding when attempting to minimize the risk of the portfolio. In this case, the optimizer should slightly favor Google in the optimal portfolio. The optimizer needs to also account for the correlation between the stocks. If the correlation between two stocks is low, the optimizer will attempt to reduce risk through diversifying across the two and weighting them equally. Finally, the optimizer needs to ensure that the minimum expected portfolio return value is achieved. Both Google and Exxon have sufficiently high simulated expected returns, and this will not be a factor in the decision. Click the Portfolio button on the ribbon. Click Optimization. Type 0 in minimum portfolio return. Next, click Calculate. The optimization module shows several portfolio and holdings results. Portfolio results shows the expected mean and standard deviation of the optimized portfolio. Portfolio holdings shows both the original and optimized amounts invested and percentage weights for each holding. It also shows the difference between the optimized and original amounts, which suggests the trades required to obtain the optimal portfolio. The optimized portfolio contains equal amounts of Google and Exxon and is equal to the original portfolio. If the difference between the optimized and original portfolio were large, however, it may mean it's time to rebalance. Click Replace. This replaces the original portfolio holdings with the optimized ones. You can now analyze the resulting unconditional portfolio statistics and time series introduced earlier in this guide. This tutorial showed you how to determine the optimal holdings for a given set of investment criteria. The next tutorial will show you how to evaluate the quality of your forecasts against realized results.